All right, next on the stage, I'd like to invite Brad Bugg. He is the founder of Evergreen Consultants, and we're going to be talking about, can we protect against the dual risks of inflation and recession?
Right. I'd invite my fellow panellists to the stage in Andy and Kieran, if they'd like to make the way. But as they're doing that, I might sort of make some introductory comments. The topic of today's session is, can we protect against the dual risks of inflation and recession? We've just heard that sort of the base case is probably that we avoid a recession and that the inflationary risks are on the decline. But I don't think we can ever sort of discount those risks because, we live in an environment where sort of things are ever changing and sort of expectations can change very, very quickly. So to help us answer that question, I'm going to be joined by two sort of highly experienced investment professionals who think about these topics on a day-to-day basis. And sort of we'll sort of be exploring it from sort of two different avenues. First, we'll be looking at it from a multi-asset perspective. So Kieran Canavan, the Chief Investment Officer at Centric Wealth, he'll be giving us some insights there. And Andy Gardner, Portfolio Manager at Fiera Capital, he's going to be giving us a perspective from a sort of global equity perspective and sort of the types of companies and the attributes of those companies that it is looking for. So I might sort of invite both Kieran and Andy to join me. And we might start off with a short presentation from Kieran on his thoughts around how we can protect against inflation and recession from a multi-asset perspective.
It's great. Hi, good morning. Thank you for the opportunity today. So what I'm going to try and do, is give you a little bit of a sense of how we look at the portfolios we run when we're looking at protecting from potentially either inflation or potentially a recession. And what we do is we've got a disclaimer, same as everyone else. We run about $9.5 billion in managed discretionary account portfolios and about $500 million in trustee portfolios. So as we start off, probably the first thing, and I'm going to go through these slides quite quickly. There's quite a bit of detail on them, so don't expect you to read it, but they're there for afterwards. If you want to refer back, it will give you an insight into how we're thinking about these things. Because typically, if you're looking to protect, our view is if you're looking to protect against inflation and a recession, and they are coming one after the other, it's somewhat easier to do. There are some situations, though, where you do end up with trying to protect for both of those things at the same time. That's typically when you see something like stagflation. It can be where you have structurally higher inflation over a period of time, or you have lower growth and you have the spike in inflation. And you'll see that there is a chart up there, the second one, bottom one on the right-hand side, which basically shows you the transition from one regime to another. So, from an early expansion to a late expansion to an early recession. One of the things you'll notice on that chart, the one that is more difficult to predict, and it's more difficult to predict because it's not always going the same direction, is late expansion into early recession. You'll see there that typically you would think late expansion goes to early recession. That only happens 46% of the time. The rest of the time it can go into late recession, or it can go back, in actual fact, to a early expansion. So that's the first thing. So what we're trying to do ourselves is get a really good feeling of what the next 12 months look like. And to do that, we look at some scenarios and we try and weight the scenarios and weight them with a time bound on them as well. So our view, if we look at the next 12 months, is actually probably a little bit different to where some others are. We really see a recessionary type of environment at a 55%, but towards the back half of the year. And we'll see how that plays out. We also look then at stagflation. We think it's a very low likelihood, only 5%. If you look at the unsustained recovery, that's really where we think there's quite a high likelihood of that now. That's where you start having lower growth and potentially these inflation spikes, so about 30% there. And then, a sustained recovery really is that Goldilocks one where a lot of things are priced for that. Where you have a very soft landing and then you run hard from there. So when you're looking at how you're going to protect, it is quite important to understand or form a view of what is the pathway through inflation, the pathway through a recession, and the timing of that. From our perspective, so Andy will talk from a slightly different perspective, But what Andy does is also critically important for us. We're looking from a top-down perspective. So from a top-down perspective in portfolios, our first point of call is strategic asset allocation. So typically, we're setting the portfolios up there for a market regime. In 2021, October, we set ours for increasing interest rates, high inflation. So that's our strategic anchor. And then what we're looking at doing tactically is basically making tactical decisions. The tactical decisions, we can do them on a monthly basis, we could do them on a quarterly basis. We will look at them always on a quarterly, but typically the markets don't conform to our quarters, so it'll be in between that. Some examples of the tactical decisions we'll make. So early on, if you've got rates rising, you're going to drop your duration on bonds. So things like that, if you really believe you're going into a recessionary environment, you're going to drop some of your growth assets. And then portfolio construction, that's the other set of tools we have, which is how do you structure your asset classes? How do you look at your underlying investment choice? Maybe if we get a question or later on we can come back to talk about some of the things that we can do at that level that make a huge difference to how you can reduce the risk or mitigate the risk. How do we blend managers and then also, because we run retail money, as most of you would, there has to be a focus on liquidity. So it's not as simple, you can't just leave liquidity out of this. What I've got on here, and I'll go through this really, really quickly, this just has the 4 quadrants there from late expansion into early recession, et cetera, and it's got some of the assets and how we would typically use those assets. So one of our main consultants to us as a group is BCA. I know BCA is speaking a bit later on. So this is some of the work that we've done with them. But your typical things there, in a late expansion, you'll be overweight in equities, underweight in bonds. You'll flip that on its head if you're going into a recession. So you can go have a look at those. Those are quite important. But once again, you've got to know your pathway. If you don't know your pathway, the transition is so, so important. So when are you going overweight bonds? When are you going underweight equities? What are you doing with your duration, et cetera? So I'm just going to talk about a couple of the strategies. I'm going through this quite quickly because we don't have a lot of time, but just to give you a sense, some of the strategies, obviously you've got inflation index bonds or TIPS as well, inflation protected bonds. The one point that I'll make with that, if you're going to use that for protecting an inflation, they're very good if you're looking at a surprise inflation, but if the inflation is already baked in, so it's already priced in, it's not going to give you any upside if you then move into those specific assets. And then on the other side, if you're protecting with recession, the other thing that you've got to be quite careful of is as you go into an early recession and move towards a later recession, is when do you take on longer duration? I think a lot of people in the last 6 or 9 months have been really caught out on that duration trade because they were predicting off some of the Fed forward views, the dot plot, et cetera, where that's going to go. And the dot plot came out this morning, so speaking about that earlier, there's 19 economists on there, 10 have said 3 cuts, 9 have said 2 cuts or less. So it's interesting. Those things are going to move around when you actually have a look at when you're moving your duration around. I'll put this up. It's just an interesting Morningstar slide because it just gives you a little bit of sense of what's happened to all the asset classes, and it shows you just how volatile the last couple of years have been. So the orange ones there, they are the ones that are the fixed income, international fixed income hedged. You can see you had a positive, 2020, negative 21, largely negative 22 and 23 negative as well, which would you expect when you're having rising rates. But then you've got equities, you can see there that you've gone from minus 5 years to 27 plus, and et cetera. So very volatile at this point in time. Once again, that pathway has not been clear, so a lot of volatility, and we'd expect that volatility going forwards. Just a little bit then on some of the things when we're looking to protect against simultaneous inflation and recessionary risks. One of the things we feel is quite important is when you're looking at your portfolios is understand the client-specific risk in those portfolios and the specific risk in there. Because you might have a strategy to mitigate that risk. That strategy might not be the best strategy for a portfolio that's a conservative portfolio and one that's a high growth portfolio. Your conservative portfolios tend to have more income generation in them as well, or need to have that because of the type of clients. So have a look at that quite carefully. Then also look at the wider conditions. I think the wider conditions is important to understand if you're protecting against inflation. Is it a potential spike you protecting against, or are you protecting against structurally higher inflation over a long period of time? If you're looking at a slowdown, is it long or short? One of the most important things to try and get a handle on is how the central banks are going to respond. That's quite difficult to do, and we heard a little bit about potential elections. So you've got to look at fiscal policy as well, because you would have seen over the last couple of years, you can have monetary policy going one way, you can have fiscal policy going a different way. And typically when you have election years, that is not when you see a lot of austerity. So in those fiscal policies, you may well see more spending. And probably one of the biggest risks we see on the medium-term horizon is how is the US going to deal with its deficits? That's a really, really difficult one, because the one scary outcome of that is potentially they decide to inflate their way out of that. That's not a problem for now, but it could be a problem for 3 or 5 years' time. We all pay for that if they do decide to do that. So that's important. Have a look what's happening in other regions. And then, using combinations of various types of allocation depending on where you're landing and as you go into those transitions. Obviously, you've got your Treasury index bonds, higher cash allocations. Cash is a really good asset class, and you've seen over the last couple of years it's been extremely stable, especially in the conservative portfolios. So depending where you're holding your cash, you should be getting at least 4.5% on that. And then defensive equity positions, and looking at other asset classes, some forms of REITs, not all forms of REITs, but then also your alternative asset classes. So that's just really a quick sort of rundown from our side of how we look at portfolios, some of the things we're looking at. At a later stage, if we do get questions, we can give you maybe 1 or 2 specific examples. So Andy, I'm going to hand back to you. Thank you. There we go.
Thanks, Kieran. I can sit down. I don't have that many slides. I can follow on straight from Kieran, really, because some of the concepts that he's introduced really help understand what options are available to an equity manager in how they can manage this challenge that we've posed around delivering high, decent returns, also managing the risks of both recession and inflation. And there are essentially 2 camps that an equity manager can choose, and I'll talk to both. Obviously, I lean one way, not the other, because typically you do have to land in one or the other camp. And if you think about it, ultimately, it depends on what type of investor you are. You're either top-down or bottom-up, as you were saying. You're either short-term or long-term. And so if we think about those types of managers within equities, and one way to do it is to be quite tactical, clearly within how you might move around your portfolio, similar to that tactical asset allocation in some respects. So you'll often be able to identify this type of way of managing the portfolio by seeing big shifts within sector allocation, maybe away from technology into commodities, or it might be managing your cash balance. Cash balances can go from 2% to 15%. You can see that someone's clearly taking a macroeconomic or market forecast and trying to manage their portfolio around that. What's been interesting in recent years, clearly since COVID, and speaking to many clients such as yourselves around what they expect of their equity managers and their experience, is that clearly you have to have some confidence that the manager himself or herself can predict the macro and time the macro. And it was great to see Diana, an old colleague, up here on stage, because they've got a challenging job. It's well known it is difficult to do repeatedly with a high hit rate. Rolling back the clock just 12 months ago, I think 80% of economists were saying that the US would most likely head into recession at the start of 2023. We ended up printing 3% real GDP growth. And then the strategists were saying the S&P is likely to be pretty much flat, and quite a few were saying down, and we did plus 26%. So it is a challenging thing to be able to do, but some can do it. Of course, though, I guess from a client perspective, is that you're often doing asset allocation. So you can experience, which can be problematic, style drift. So what you think is an allocation to a growth manager suddenly looks like you've got a load of value stocks, or what you think is a certain dollar allocation to equities, and then within that equity bucket you realize someone's holding quite a lot of cash, so you're holding more cash as part of your asset allocation than you realized. And I think some of the ways in which clients have sort of addressed some of these challenges, and it's certainly come back more into fashion, is that rather than try and rely on the ability for a portfolio manager to retain that tactical edge for the duration of their careers, or take the risk that they can transfer it on to maybe another member of their team if they were to pass on at any point, is to invest in a quantitative equity manager that is systematically trying to literally do exactly this point, take tactical bets. That's what they are designed to do. And given that macro signals are sort of getting broader and the responses to them getting more dramatic and quicker, it probably does make quite a bit of sense. Now, the opposite camp, or the different camp, I guess, is to look at almost flip the question on its head. And rather than say, I can predict the macro, it's actually just to assume that uncertainty is the norm rather than the exception. And then the goal there is to effectively build a portfolio of sustainable and resilient companies that can withstand the vast majority of shocks, because you never know what the next shock is going to be. And this applies not only to fundamental listed equity investors, but it's exactly the kind of thing that would be applying to private equity, of course, because you're having to commit to companies and portfolios for 5 years or 10 years or beyond. And therefore, you're hopeful that that company will be in good shape, whatever the macroeconomic scenario is that they're going to be faced with. And so this is what we would do. And so just to elaborate on this point of why it's important that fundamentals can do some of the heavy lifting in meeting both the challenge of delivering the returns, but also helping you manage the risk. And I would say that it's important to recognize, and I can come on to this later if we talk about companies, it's a very certain type of fundamentals. I think it's being used very liberally these days in terms of what we mean by fundamental investing. But we can explain more of that in a moment. But just at least to provide some evidence and demonstrate that fundamentals can help you deliver to these dual goals. We've done this analysis here on this slide, which is breaking down total returns into the 2 key building blocks. And again, you could ask this of your listed equity manager or your private equity manager. Where are your returns being derived from? So the left-hand chart here is showing you our fund, because it's a proxy for this fundamental approach I'm trying to convey, and then the index, which is sat next to it. So on the left-hand side of the chart, you can see the total return of the fund at 17.5% annualized. This is in US dollars. I think it's just over 19 in Australian dollars, but the exercise had to be run in US dollars. Of that 17.5, 15.7% is coming from the compounding up of those fundamentals, and then a small contribution from multiple. So that's 90% of that total return coming from fundamentals. If you compare that to the index, so the ACWI, this is the MSCI All Countries, it's done 8.5% annualized growth in fundamentals over that same 7-year period. So what you've got there is a 700 basis point premium from the fundamental approach here, which is working for you each and every year. And we kind of call it structural alpha in a sense, because what we're trying to say is that it's a more repeatable and reliable source of alpha generation, in our view, of course, biased view, than perhaps multiple. Multiples are inherently volatile, and in particularly given what Deanna was saying, where we are standing today, multiples are a little bit more elevated. It's unlikely to be the same generator of alpha generation, perhaps going forward, as it has been. So fundamentals need to do the heavy lifting to generate returns. That's key point number 1. The chart on the right-hand side is talking more towards the risk side of the equation. And so what we've here is we've got that fundamental bar for both of the fund as well as the index expressed as a time series, so you can see the stability of the journey. And that's why the top line is, again, 15.7, and the bottom line is 8.5. And that gap will widen over time. That's the benefit of compounding working for you. But during that recessionary period of COVID, which is the red line there, earnings revisions for the fundamental approach, sort of the drawdown in earnings revisions, taking consensus estimates for comparison purposes, was minus 11% versus minus 22% for the index. In addition to that, the recovery was higher or quicker for the fundamentals. It was back, that portfolio, our fund was back above the previous peak within 3 months versus over a year for the index. And I think this is important for fundamentals and understanding is that we often talk about drawdown. Understandably, it's really important, but less attention is paid to recovery. And it's a good question to say, when do I get my money back? And this is ultimately where I'm going with explaining the importance of fundamentals, is that they are like the anchor point. And price or multiple is a bit like your elastic band, which deviates around that anchor point. But it can only stretch so far before reverting back to its fundamental reference at some point. Now, if you're going through a recessionary period or some macroeconomic challenge, It's really important to see how much protection you've got within those fundamentals, because it's going to be better able to tell you when price will reassert itself back towards that fundamental trajectory. If you've not got the right companies within your portfolio, and you've not got the right fundamentals, and you're going to see a permanent impairment in those fundamentals, there's much less reason for you to recover your capital. So all in, I guess here's just a quick demonstration that fundamentals do matter. We're quite particular about what those fundamentals are and how they're generated, but there are companies certainly that are able to deliver to this dual sort of challenge of both delivering decent and high returns, as well as managing to risk. And coming back to Diana's slide around asset allocation and what the returns of a diversified portfolio might be able to generate, clearly, arguably, if you want to do better than that, I would suggest that alpha is going to have to be a key component of that, and how you want to generate that alpha is obviously worth considering, whether it be driven by fundamentals or driven by multiples.
Great, thank you both for those thoughts. I might sort of start off with a couple of questions, and firstly maybe to you, Kieran, in terms of, you had the slide which sort of looked at the different scenarios, and just interested to think and sort of how often you're revisiting that, because things obviously move pretty quickly in markets, and when there is changes, sort of how does that sort of impact the individual strategies within the portfolio?
So look, we've got a team that would be looking at that on an ongoing basis. But if we have a look at some of the inputs we use, because we use inputs, as I said, from BCA, from State Street, from Goldman's as well, and JP Morgan. So those are the main inputs we're looking at. Typically, they've been updated, and we look at them very carefully on a monthly basis. So we would be reviewing that at least on a monthly basis. But things happen during the month that may well change that. That said, we are running physicals, so we don't have the luxury, at least at the portfolio level, of running a derivative structure over the top of that. Within some of the funds, we have that luxury. So, we want to be looking forward. Before we make a decision, there's two things that we want. We want very high conviction, which is really important before you make a decision, because there's a cost if you're running physicals and you've got to trade them. And then we also want to know what the term of that conviction is on. So, that continual review, I'd say monthly is probably where it's been, that chart will be updated on a monthly basis. It doesn't change that much, though. But you may well have a big change if you have the Fed, changing their tone a lot, significantly. That may be a change. And, from there, we would look at the length as well, so conviction. And is it, is it a 3-month conviction? Is it a 6-month? Is it a 12-month conviction? Typically, we've looked at the last 14 years we've run these, and our decision-making is substantially better when we have very high conviction and at least 3 to 6 months timeline on that conviction.
Maybe just an extension of one point Andy made as well. He mentioned that sort of some managers move allocations around within their own portfolio. So how are you controlling for that in a multi-asset perspective?
Yeah, so we look at the managers all the time. We understand what they're doing all the time. We actually have an actuary that sits in the business that's put the systems together, so we can monitor exactly what the managers are doing. So we are looking for style drift and things, or taking additional risk that we're not aware of. And we have moved hundreds of millions out of individual managers when they've taken risk that they haven't told us about. But really then also what we're trying to do, one example would be, sometimes examples are the best way of doing this. We see a lot of volatility at the moment. So if we look at how we blend international, for example, international equities, one of the things we did when we did our SAA change, which was October 21, and before that we were looking at, how do we get a very good core manager in there? And it's similar to what you've been saying as well. You're looking for someone that is systematic, so you're not getting the biases that come in there. Getting someone that, when you look at it, you can get very consistent outperformance. Also, someone's not taking large bets. We use a firm, it's one of the managers, Vinva, that is exactly that for us. So getting the right manager in there and making sure that we're tracking what they do. And since we seeded that strategy, they've done about 700 over the Miski Equi since we seeded. So we've had it for 3 years. So that's a really important one, is getting those blends right, making sure the manager, but then monitoring what they do as well. Don't just, especially when it's so volatile, you need to monitor what they're doing, because they can have that style drift so easily.
And maybe for you, Andy, just in terms of the types of companies you're looking at when you're sort of concerned about an inflationary or recessionary environment, what sort of attributes are you looking for from those companies?
Yeah, thanks, Brad. And again, maybe by example, we can change the slide. Is this? No. Did it automatically before. There we go. Yeah, so ultimately, the companies that you invest in are going to determine the outcome that you generate. And again, there's only a very few number of companies that can genuinely deliver to all of that challenge of delivering high and stable returns, as well as then manage to recession, particularly both those, recession and inflation. And it applies, the characteristics you're looking for apply whether it's private or public, whether it's small cap or large cap. And there are some unique characteristics. For us, we assess every company to try and achieve that in the same way, and it's how we sort of define whether or not a company is, in our terms, sort of exceptional or not, and it's the characteristics of competitive advantage, capital allocation, growth, and predictability. Now, what that creates is many of the metrics that you might be familiar with. So understandably, if we're trying to deliver to all of this, and what Kieran might find within his asset allocation models, and I think it was on his slide, you know, a quality approach should be useful. So you're looking for return on capital, high profitability, stable and supportive growth, as well as strong balance sheets. But if there's one aspect I think is really important, particularly around inflation, that is a characteristic that's almost a manifestation of all these things, is pricing power. And obviously, Warren Buffett, the late Warren Buffett, I should say now, has been talking about this for over 50 years, and he wrote a book in the late 70s, the last time we had stagflation, and how, you know, important it was on that during that period. And so here I've just chosen a company because it's relatively well known, and I think fairly simple to understand, but it's almost the definition of pricing power, which is Hermes, which is an iconic luxury brand. And on the right-hand side, you can see some of the bags that it's most well known for. You've got the Birkin bag here. So at the top, you've got the standard Birkin at a mere $20,000. And then you've got a limited edition model in the middle, which comes in at around $100,000. And then at the bottom, you've got the kind of bag that's only ever sold at the likes of Sotheby's between $1 and $2 million. So there's certainly something different about a company like Hermes. And what is that? So you break it down, and ultimately, first and foremost, it's those competitive advantages. It's you've got the uniqueness and exclusivity of a brand that has been around for 200 years. You can't replicate overnight a 200-year heritage, of course. What is less well known is how well they manage the whole value chain, from production to manufacturing to distribution. All bags and scarves are designed and crafted by artisans by hand that have had over 5 years of training. It enables you to manage pricing, manage inventory, and deliver personalization, which is increasingly important for, you know, higher end of luxury and a great margin driver. And then, of course, it's a family-orientated influence company still, so they're genuinely allocating capital back into the brand, nurturing and protecting that heritage, and thinking in terms of decades and generations. But interestingly, coming to this point around pricing power, when we're thinking about growth and predictability, so the percentage of people and population that's entering the high net worth and ultra high net worth cohort far surpasses the volume of material, particularly their key goods that they're willing to sell. So they're deliberately underselling relative to demand. And that creates at least 2 years of waiting list for most of these bags. That creates a lot of visibility. In terms of pricing, they always price above costs. So for the past 50 years, pricing has been almost consistently in a range around 5 to 7% per annum. And we spoke to a senior director of Hermes a few years ago just to come up with an understanding of what's the absolute number of price that how you think about that. He said, well, it's quite simple. In the first instance, we'll work out costs, and then we'll multiply it by 5, and that's your base case. So there's not many companies in the world that can effectively solve for a margin right from the outset. But as a great indication of price, particularly for any luxury company, is how much things are selling for in the second-hand market. And so Hermes has always got the highest premium in the second-hand market. And it's interesting, if you track some of these bags over time, not only they outperformed inflation, they've also outperformed the S&P. So I guess a closing thought is that maybe rather than use bonds and stocks to try and protect against recession and inflation, we should all be buying Ferraris and handbags instead.
I might invite any questions from the floor, if there's any.
Just for Kieran, you didn't reference gold or even commodities more generally. Just be interested in comments on the potential sort of.
Yeah, so I mean, they are on, you'll see in some of those slides, they actually are in there. So we do have, there's the ability to use commodities and gold, especially in some of the, if you're looking to mitigate some of the risks that are there. Typically in our portfolios, we haven't used them a lot, but we do have commodity exposure. We haven't had gold exposure in there over the period of time. And that's a lot to do with the consultants that we're using and the assets that we've got in there and how we're pulling those assets all together. But we recognize absolutely there are uses for them, and they're actually on the chart that's in there. So you'll see when we also feel that they are better used. Often we're leaving it more to the, and that's why I didn't go into too much detail, it's the underlying managers that are making some of the calls on those. I talked about that equity manager, Vinva, as well. I mean, some of the things they will use someone like that that'll make the call between, energy and, some of the other staples that may be there, et cetera. So we often leave that underlying, not at our level, but to an extent we may from time to time. So I hope that answers your question. It's just something that we're not doing actively in the portfolios, is moving in and out of gold and commodities.
Kieran, Andy, Brad, thank you very much. We're just going to we're staying on pace. I've been given the instructions to start playing the music. So thank you very much, guys.
Thank you.